Chairman Frank, Ranking Member Capito, and distinguished members of the committee, I'm Bob DeWitt, Chief Executive Officer of GID Investment Advisors, testifying on behalf of the National Multi-Housing Council and the National Apartment Association. It's important to draw a clear distinction between the performance of the single-family and multifamily sectors. The multifamily finance system has been an unqualified success for over 2 decades. As Congress crafts solutions to fix the single-family problems, you should be mindful not to do so at the expense of the much smaller, less understood, but vital multifamily sector. Since the early 1990s, apartment developers and owners have had access to reasonably priced capital throughout all economic cycles as a result of the secondary market. This has allowed them to produce millions of apartment units affordable to working families, those households at or below area median income, in communities all across the country. We didn't overbuild, and those apartments produced within the system came at virtually no risk to the taxpayer. The 2 GSEs have had to foreclose on fewer than 100 apartment properties over the past 20 years. Today, their delinquency and default rates remain under 1/2%, a tenth the size of the delinquency and default rates plaguing single family. In normal times, the GSEs finance approximately a third of the capital going to apartments. Banks, insurance companies, conduits, and other private players have made up the other 2/3. However, the past 18 months have not been normal times. Those purely private players abandoned the market and have not and cannot yet return. As a result, Fannie and Freddie currently finance some 90% of the debt capital for apartments. Clearly, this is not sustainable nor desired, but neither is the uncertainty regarding what role the private market can play in financing apartments. The apartment industry urges you to consider the following key points for inclusion in any reform measures. Number 1, mission. The public mission of the federally supported secondary market needs to be clearly defined and should be focused primarily on using the government guarantee to provide liquidity to the multifamily mortgage market. This liquidity will help meet the current and growing need for workforce housing. Access to a steady stream of capital promotes affordability. Affordable housing is one of the nation's most pressing needs, and multifamily housing is inherently affordable. Fully 90% of the apartment units financed by the present system over the past 2 decades, literally millions of apartments, were affordable to families at or below area median income. This includes an overwhelming majority of market rate apartments with no direct federal subsidy. The Harvard University Joint Center for Housing Studies estimates that we already have a shortage of some 5 million units of affordable rental housing. Our industry cannot meet the nation's current or future housing needs or refinance the approximately $200 billion in mortgage debt coming due over the next 2 years without a fully functioning secondary mortgage market. Number 2, the private market simply cannot meet 100% of the multifamily demand for capital. Any new or revised secondary market system must recognize the unique needs of the multifamily sector and create a capacity to fill the gap left by the private sector. There are structural impediments facing banks, insurance companies, and conduits that preclude them from financing more than they traditionally have. As the GSEs shrink their overall presence in the markets during this transition, we expect them to continue to be the primary source of the apartment sector's mortgage capital. Number 3, private capital is preferable to federalization of the secondary market or the creation of a new federal entity. Federalization will limit the broad range of finance products required to maintain a healthy and changing multifamily market. Attracting private capital based on the federal government guarantee allows for needed innovation and flexibility. Number 4, explicit guarantee. We believe that the transition to any new system should provide access to explicit federal guarantees for multifamily mortgage securities and loans. We support a fee structure to support this backstop. Such a risk-based guarantee on the underlying mortgage would provide reserves against mortgage losses, thus protecting and insulating the taxpayer from loss. Number 5, portfolio lending. Securitizing multifamily loans is not always the best way to manage credit risk. Unlike single-family loans, they are not easily commoditized, and therefore any new system should permit the ability to hold loans in portfolio. Number 6, secondary market infrastructure. During these transition years, we believe it is critical to retain many of the resources and capacities of the existing GSEs. And technology expertise, established third-party relationships that are critical to a well-functioning secondary market. If I can leave you with one message today, it is that a government-supported secondary market is absolutely critical, at least during an appropriate transition period, to the multifamily industry's ability to continue to meet the demand for safe, decent, and affordable rental housing. I thank you for the opportunity to be with you today, present the views of the apartment industry, and I look forward to your questions.
Next, Janice Bowden, who is the Deputy Director at the National Council of La Raza.